It's been quite a week here on Wall Street. We started with a strong rally this week, but now here we are at the end of the month of April, and we have the Fed meeting and the jobs report up ahead. So joining me now is Stephen Guilfoyle of Sarge 986. Sarge, pleasure to have you here today.
The pleasure is mine, Remy. Thank you for having me.
Well, it's been quite a week for earnings as well as politics and a little bit of geopolitics thrown in for fun. So given that we have received some economic data as well as earnings, where do you stand in terms of the bigger picture?
Well, that's a really loaded question. Yeah. Obviously, if something stupid happened in a place like North Korea, that would take precedent over everything else. But being we've averted that disaster for 60 years, let's hope our luck will hold out. Earnings are by far the largest market-based mover that we have right now. I mean, I think stocks are up maybe 11 or 12% this year. Earnings are showing an 11% growth year over year from last year. The EPS beat is running about 78%. The revenue beat's running about 64%. Both of those are well above established norms. So we're having a good season. When stocks miss, they get hurt, but we are having a good season, and that has been more than the French election, even more than this White House tax plan, which is really a wish list, but it's not. I'm not going to knock it. I want improvement in taxes, but it's a wish list. Earnings have been the driver, and will continue to be so for the next month.
And Sarge, you brought up the tax plan. We got that on Wednesday afternoon, and the market did not show any euphoria, but given that it was just a one-pager and we know how long it takes for anything to happen in Washington, D.C., there's still a lot of work when it comes to tax reform. So what did you take from that report?
Well, I'm all for a 15% corporate tax rate. I mean, who wouldn't be for such a thing, especially when they own a business? But the tax plan is, like you said, it's going to take a long time. It's going to take months. This has to go to Congress. They have to fight about it. Then they have to present it to the president. If they pass it, both houses, the president would obviously sign it if it showed up in the form that it's in, or maybe he wouldn't, because he usually actually starts out at pretty extreme positions and lets himself be drawn back to the middle. So we don't even know if this is really where he wants to be or where he wants to start on some of these issues. We're a long way out. If you're going to trade based on this tax reform plan, I don't think you're going to trade yet. Sell in May and go away is the old saying. It's kind of ridiculous. This tax plan shouldn't propel you to buy or sell going into May.
And last but not least, as we head into the month of May, we get the jobs report at the end of next week, and then we have the two-day Fed meeting. So what do you expect to see next week?
I don't think we'll see anything too crazy as far as jobs go. We all know that unemployment is minuscule at this point, even though wages are also minuscule. So it's kind of a double-edged sword. As far as the Fed goes, they won't be raising rates this month. It's not a press conference month, and we'll all know how they like to do that. Right now, the next hike is on for June. I think the probability is about a 67%, so a 2 in 3 chance that you'll see a rate hike in June. But a lot of that will also depend on how the macro shakes out. The macro has been on and off. It's been not really supportive of a rate hike, but they've already shown us they don't really need to see supportive macro if that's where they want to go. I do believe that most of the Fed has turned rather hawkish. Maybe they know something we don't. It's very possible. We all saw the first quarter. We didn't come too close to going into negative territory probably, but we've come closer than we would like to be. And that's what this new tax plan, which is only a wish list, is really all about.
Okay, Sarge, well, before I let you go, I have one more question for you. We have a lot of concerns regarding geopolitics. Now, for now, we don't know exactly how this will play out in the coming days or even in the coming weeks, but how are you positioning yourself in terms of risk?
In terms of geopolitical risk, I mean, I always recommend a certain percentage of your portfolio in gold. Right now, I'm recommending a 7.5% percentage, but I'm always between 5 and 10. Those are my parameters. I do believe you need something like that just in case the craziest thing in the world does happen. On top of that, you need clean water and ammo. But in terms of the marketplace, I don't let geopolitical risk, other than the events like, let's say, in France or in the upcoming election in Italy affect my trading so much. I do believe that the international picture is slightly rosier than the domestic picture in terms of GDP right now. So let's say you want to invest in companies that have more exposure abroad. Something like a perfect illustration of this would be Under Armour, the apparel maker. We saw just the other day, I think it was yesterday, they actually had negative growth in terms of domestic sales, but their international sales were fantastic. Then you had Southwest Air, a mostly domestic airline, which really struggled to meet their goals. So I think the U.S. is growing, but internationally the growth is greater, and that's probably where you want to have some exposure.
Okay, well, Stephen, great to have you here today, and thanks so much for your insight and analysis as always. Have a great weekend.
Thank you, Remy.